When it comes to building wealth, the debate between stocks and real estate has always been heated. Recently, Stephan, a well-known finance expert, shared his detailed perspective on this very topic. Today, we're going to dive into what Graham thinks about stocks versus real estate, break down his opinions on the pros and cons of both, and explain why his take might completely change how you view investing. If you're trying to figure out whether to put your money into property or let it grow in the stock market, this video is for you. Make sure to stick around until the end, where we'll talk about the big takeaways from Graham's experience and what you can learn from it. For Graham, real estate has been a cornerstone of his wealth-building journey. He began investing in real estate back in 2012, when market conditions were vastly different from today. His first purchase was a $59,500 foreclosure in San Bernardino County, which he bought outright with cash he saved from working as a real estate agent. After investing another $112,000 in renovations, he turned that property into a solid rental asset, now worth $400,000, bringing in $1,500 per month in net rental income. Over the years, Graham expanded his portfolio, adding properties that he fixed up, rented out, and, in some cases, sold for substantial returns. For example, he bought a West Los Angeles property in 2016 for $780,000, put $150,000 down, and renovated it for $60,000. With a low 3.375% mortgage rate, he earned a 280% return on his investment and collected $150,000 in rental income over 5 years. One key factor Graham emphasizes is how leveraging low-interest mortgages and buying properties at undervalued prices allowed him to maximize returns. He also used cash-out refinances on some of his properties to reinvest the money and generate additional profit, all while locking in long-term fixed rates. But here's the catch. Graham acknowledges that his success in real estate was highly dependent on timing. Market conditions at the 2010s were far more favorable, with lower purchase prices and historically low interest rates. For buyers today, replicating these results would be much more challenging due to higher mortgage rates, rising property taxes, and increased maintenance costs. The challenges of real estate. Today, Graham points out that while real estate can still be a great investment, it's not as straightforward as it used to be. Take his first property, for example. If you were to buy it at today's value of $380,000 with 15% down and a 7% mortgage rate, your total monthly costs, including mortgage, taxes, insurance, and maintenance, would be around $2,900. However, the property only rents for $1,950 a month, resulting in a $1,000 monthly loss. Additionally, rising costs for home insurance, labor, and materials have made real estate investments more expensive to manage. Graham emphasizes that, unless you're in a market with above-average appreciation or you can find a deeply undervalued property, the numbers simply don't add up as favorably as they did a decade ago. Graham's opinion on stocks. On the other hand, Graham sees the stock market as a more accessible and less labor-intensive way to grow wealth, especially in today's environment. Historically, the S&P 500 has delivered an average annual return of 10.6% with dividends reinvested. The beauty of index funds, in particular, is that they allow you to invest in a diversified portfolio of companies with minimal effort. For example, Graham points out that if you were to invest $100,000 in an index fund and let it compound at 10.6% annually, it would grow to $750,000 in 20 years. This is achieved without dealing with tenants, property maintenance, or market fluctuations in real estate. Graham acknowledges that real estate offers the unique advantage of leverage, allowing you to control a larger asset with a smaller upfront investment. However, he believes that leverage only works well when interest rates are low and purchase prices are reasonable. In today's market, with 6% to 7% mortgage rates, the cost of borrowing often outweighs the benefits of appreciation. The verdict: stocks versus real estate. So, where does Graham stand in the debate? His conclusion is nuanced. For him, real estate was an excellent investment when conditions were right: low prices, low interest rates, and a market ripe for value add opportunities. But in today's high interest, high cost environment, he believes stocks, especially index funds, offer a more efficient way to grow wealth with less hassle. That being said, Graham doesn't dismiss real estate entirely. He notes that owning property can still make sense if you find the right deal in the right market. Additionally, for those looking for a long-term place to live, buying a home can be a smart financial decision. However, from a pure investment standpoint, he now leans more heavily toward index funds, particularly for their simplicity, liquidity, and consistent returns. Graham's key takeaways. If there's one thing Graham wants people to understand, it's that both real estate and stocks have their pros and cons. Real estate can offer incredible returns if you buy smart, leverage effectively, and manage properties well. But it's also a lot of work and requires the right market conditions. Stocks, on the other hand, provide a hands-off approach to compounding wealth, making them an excellent option for many investors, especially in today's market. The biggest takeaway? Diversify. Don't put all your eggs in one basket. By spreading your investments across multiple asset classes, you'll reduce risk and increase your chances of long-term success.